Welcome to Framework Fortune and welcome back Framework Fortune community. In this video we're going to dive into fundamentals for stocks and what fundamentals that I look at when I'm looking for stocks to invest in over a long period of time. There's a lot of different things that are considered fundamentals, but I don't use them. Why? Because they're unnecessary. So let's not waste any time and dive right in. Now, mainly I'm a technical analysis trader, which if you're new to the stock market, that just means that you're trading mainly off of chart patterns, indicators, trend reversals. You're not looking at what the businesses are. You're just looking at the movement, price action of the stock as it's moving. Where fundamentals, you're looking at the business. And I think a lot gets lost in translation when it comes to long-term investing in the stock market with a lot of books and information that's out there. And it seems more complicated than it should be, at least in my opinion. And what I've used has worked for me, so I don't see why it wouldn't work for anybody else. But of course, always do your own research. Don't just take my word for it or anybody else's. I want to see if it's a good business. A lot of people forget, investors included, even the most experienced advanced investors, that the stocks that you're buying are not just a piece of paper. You're buying into a business. All you want to buy into is a business that is going to continue to make money. It's pretty simple. If the company is at max potential, they can't get any more customers, well then you know there's no more growth in that business. So are they going to be paying back the shareholders? They're going to be giving the shareholders dividend payments at that point. If yes, then hey, you've got a solid business that's probably going to be in business for a long time and it's going to pay you nice dividends, but you may pay a high premium for it. So I don't really look for those type of stocks. I don't invest in the Apples and the Microsofts, the Googles, the Facebooks, the Berkshire Hathaways. I don't invest in those stocks. It's too much capital. I'm not a millionaire yet, and I'm not going to be putting all of my capital on the line on 1 or 2, 3, 4, 5 shares of some very high priced stocks that aren't going to move that much higher. And if they do, it's a lot harder to move from $5,000 to $10,000 than it is from $50 to $100. So for my price range, I like to stay $2 to about the $40, $50. Sometimes it depends on the company. I may go up to $100 for it, but that's where I generally stay at for my longer term holds. And the reason for that is because I can buy more shares and I can see bigger gains. And if it's a dividend that I'm after, I can get more dividends if I own more shares. So it only makes sense to me to try to get the best bang for your buck. But let's stop talking and actually take a look at a few things. Now, the chart analysis, that of course is going to be technical analysis, and I absolutely think you 100% should know some technical analysis, whether you're long-term investing, swing trading, but definitely if you are day trading. But this is a technology company that I was invested in before I got out at the beginning of this year. I completely cleaned out my portfolio of my long-term holds. I was green in all of them, and that's just because I'm very bearish on the stock market. If you've been following me, you know I'm bearish on the whole entire economy of the US and all of that. So I'm not going to be holding any stocks until I see a very nice market correction, and then I'll start building me another portfolio. This was one of my picks. It did very well for me. Dipped during COVID all the way down to 430. So this portfolio I had started last year in this COVID dip, because before that I've been trading for 7 years. If you look at the SPY, there's not been a great time, a big pullback to get in anywhere in the market. It's pretty much going straight up. So I took the COVID dip as an opportunity to start building a new portfolio. You can see how this performed for me. Right there's in January, so I sold it around that $14 area, but they pay out a monthly dividend payment, which is very nice, and it's usually around 10 to 15 cents. Let's see what they paid out recently. So recently, yeah, 10 cents. So you're getting about $1.20 to $1.50. And back down here when I bought this at $4 or $5, that was a good deal because the dividend yield at that time, since it was $1.20 annually, would make that around a 20% dividend yield. So by buying more shares of this $4 to $5 stock and adding to my position on the way up and collecting these dividends every single month, by the time I sold, I'd made a nice little profit on this guy. So when this thing comes comes back down again from whatever happens, some type of correction like it did right here, then this will probably be one that I add back into there. And the reason why is not only the dividends. Your long-term investing, I definitely would check into some dividend paying stocks. It's great. It's passive income. You're just putting your money in the shares of a company and they pay you per share the amount of the dividend, either monthly, bi-monthly, quarterly, or annually. So you're constantly getting a nice cash flow off of the stock if you find a cheap company that you can load up on some shares. So dividends, definitely something you want to look at, and that's pretty much all I look at on the dividend side is how much am I getting back for the dividend payment on the money I have invested. For instance, right now, if I was to buy 2 shares of Apple, that would be about $300, a little over. And if I was to buy $300 worth of Horizon, I'm gonna pull the calculator up because I can't do that math right off the top of my head. And you see, we get 17 shares. So about 17 and a half shares Horizon times that $1.20 dividend payment annually, that would be $20 a year for that 300. And let's see what Apple's paying out. So Apple pays theirs out quarterly and they pay 22 cents, basically 22 cents, so that's 80 cents a year. So we pull back up the calculator. 2 times 80 cents, because we only have 2 shares of the Apple, would only be $1.60. So for that same $300 that I can cash flow for $21 a year on Horizon would be only $1.60 cash flow on Apple. That's why I look for the cheaper price stocks that pay out consistent dividends and have consistent growth. You can buy more, which means you can cash flow more off of those dividend payments. But now let's actually get into the other stuff I look at besides just dividends. So we're buying a business. When you're thinking about buying into a stock, that's what you're doing. You're buying a business, especially if it's long term. If you're day trading and swing trading, you're getting in and out of those stocks pretty quick. You're not really buying into the business. You're just buying into the notion that you can sell it for a nice profit in the short term. But long-term investing, since you're trying to buy a business, you got to look at it like you're trying to buy a business. If you take the stock market completely out of the equation, if you were going down the road and seeing multiple businesses for sale and you wanted to stop and see how much they wanted for each of those businesses, how would you evaluate those businesses? Are you going to evaluate businesses on the street that don't have any shares or anything by looking at the EPS, the earnings per share? No, because it doesn't exist. So what are you going to look at? You're going to look at their cash flow, their assets. What does that business own? How much money do they have? How much money are they bringing in? How much money are they in debt? So the biggest thing I look at is the balance sheet. So we can see on Horizon that assets is this blue bar. It's been growing. They've been growing their assets. That's a growing business. That's what we like to see. Now their debt has been rising. That's the little light green bar, but they're staying pretty close to where they normally stay with their debt to income or their assets. Currently for 2020, they had 407 million assets and only 194 million in liabilities. So the debt to assets are 47%. And it is a little higher than I normally like. If you're looking at debt to assets, think of it the same way you would as your own personal credit score. If you've got 100% debt to asset ratio, you're not going to be able to go out and get a loan for anything. If you're over 50% debt to asset, or I should say debt to income, that's the banking term. But debt to income ratio, if you're even at 50%, you're not going to be able to get any money, take out any loans, do anything like that. So I don't want to see them over 50%, but the same thing with your personal credit. If you're staying in that 25% to 10% area, somewhere in there, that low debt to asset, low debt to income ratio, then guess what? Banks will give you money. And I'm not saying that you need to go take money just because you can get it. I just want the company to have the option there. So if something does go sideways, like a pandemic out of nowhere, then I know they can get some financial help. And they also have all those assets that they could leverage to keep themselves afloat as well. But if you have all that debt, doesn't matter about the assets because they're still not going to give you money. So I just want to see businesses that are ran like good businesses. That's it. But see, you can see right here, price to earnings ratio, basic EPS. Neither one of these exist when you're buying a business outside of the stock market. So that's why I do not look at it. Market capitalization without any shares would be kind of hard to figure out, and it's not really something that you're looking at when you're looking to buy a business unless it is a public company. But the dividend payout, 7%. That's beating inflation. I like that. But I also pop over to the income state after I'm done with the overview there, and I look at the gross profit. Has the gross profit been going up since the company in the last 4 or 5 years? And you can see the gross profit has been going up, but it has started decreasing. So that's a little concerning. We'll have to see what's going on there, but that could be good for it to come back down cheaper. And then I also look at their total revenue. Has the revenue been increasing? And you see their revenue is actually decreasing. So this is not looking as good as it used to me. Of course, they probably have had some issues with COVID because this company invests in technology startups, and a lot of people right now are tight on money. So they could easily turn these numbers around, I'm sure. They're just an investment company. But the good thing is they are in the positive. See, back in 2017, they had a negative $1.5 million gross profit. I don't want to see negatives. I want to see positives. And preferably, I want to see positives in the percentages too, going up. And we're not seeing that here. We're seeing a decrease from the previous year. Now, of course, you want to look at cost of goods. That's your cost. You can see they do have some expensive cost of goods right now. $6 million in 2017. It's doubled since 2020. So we could look further into that to try to see what is going on. So right here, it just shows the other cost of goods. So this doesn't actually show us what those cost of goods are. So that's why if you want to get that deep, you'll have to go into the website of the company and try to find that information in their SEC filings or in their earnings reports. To me, it's not that big a deal. The debt to asset is more important than the cost of goods, because if they have a lot of assets and they have very little debt, then more than likely their operating expenses, their cost of goods are going to be low. So that's up to you if you want to dig that deep into a company. You do your own research, of course. So I do look at net income as well. It's another number to look to see if it's growing. And we have decreased for 2020, but looks like it may turn back positive. But then you can see here's some of this stuff I was talking about. Dilution adjustment, basic EPS, diluted EPS, average basic shares outstanding, diluted shares outstanding, EBITDA, EBIT. Those don't exist for normal businesses. If they do, I don't know anybody who's looking at them. They're looking at how much is this business going to make me for my investment, and all that is just unnecessary. So if you go to the balance sheet, you can get more of a breakdown of the assets and liabilities and their total equity. You can see their total equity has increased year over year. So that is a nice sign that their value is going up and those total assets have increased. So even though the revenue's down, they're still increasing assets, which is a good sign. And then you see the total debt there. Now, the only other thing I would look at besides the price and these fundamentals is the free cash flow right down here at the bottom. I don't really care about all the rest of this, because all the rest of this is getting to this free cash flow. This is the most important thing on this page. So your free cash flow is basically the same thing that you have after all your expenses and living costs every month. If you're saving, $200-300, $500, maybe $1,000 a month, depending on your income and situation, that would be your free cash flow. So if you weren't saving any money, didn't have any money after all your costs and expenses, you'd have a negative free cash flow. And a business that has a negative free cash flow is not a well-run business. You want a business that is being profitable. So I always look there, and you can see their free cash flow is going up year over year. So they are making more and more money. Now, I do look at float, and float is the amount of shares available to the public. Mainly, I use it for day trading and swing trading, but I do want some growth out of the stocks I invest in. There's not too many stocks I could think of that have a very low float, like a 1 million in float, like we day trade every day, that I would put my money in long term. I don't think there's one that I would. But I also don't want my money in something that has billions of shares out there that barely moves every single day. I want to see consistent growth, so I'm profiting from the growth, and if it's got a dividend payment, I'm also profiting from the dividend payments. And if you invest back your dividend payments into the same stocks, which there's a way to have companies set that up automatically for you, it's called a DRIP system. You can look that up, DRIP. It's also in my Water REITs video, I'm pretty sure. But that's all it is, just an automatic system where it reinvests your dividend payments back into the company. That and long-term growth, an uptrend, is going to compound the profits that you're making. And that's pretty much everything that I look at for fundamentals as far as the statistics and the numbers. We just want to make sure that it's a well-run business that's not in a lot of debt, that is making money, that is profitable, and that is growing. So So the other part of fundamentals is looking at what the actual business does. So with Horizon, we know it's an investment company. They can continue to grow because all they're doing is investing in new startups, loaning the money out to the new startups, and then the new startups pay them back either with shares that they sell or with straight money or maybe assets. But what if it's not something as straightforward as an investment company? CRISPR Therapeutics is a pharma company. So I would go to the website, and we'll pull it up here. You can usually just Google the name of the company and their website will come up. You see this CRISPR Therapeutics website, and right off the bat, what do we see? Gene-based medicine, and over on the side, gene editing. So now we know, okay, this pharmaceutical company is working on gene editing, which is a controversial field, but is also a field that could change medicine altogether, as there's not much gene editing treatments on the market available at the moment. Now, the mRNA vaccine is part of that gene editing, so if you didn't know that, maybe go dig into CRISPR Therapeutics and learn a little bit more. But we know the population is going to keep growing. More and more people are going to get sicker, which means that the numbers of people who get sick will be going up. This has potential to change the future. So not all stocks that you look at may have this big a potential to change the future, but let's just say it's something simple like automotive company like Quicken Lube or something like that. I don't even know if they're public, but just using them as an example, if it was a chain across the country of that Quicken Lube business, and I would be looking to see, okay, they're doing basic oil changes, things like that. What are they going to be bringing in the future that is going to continue their growth as a business? Because if they're just going to stick to oil changes and doing the little stuff that they do, I mean, how much more can you spread out across the country? How many more businesses can they open that would be profitable? Because at some point you're going to hit a number where you can't open any more businesses because you're just everywhere, and the supply is going to outweigh the demand for your business. And all this applies across every single sector too. So let's recap real quick the fundamentals I use for my long-term investing. First, the price range. I like to stay in the cheaper stocks, the mid-cap, the small caps that are actually good companies with low debt, high assets, positive cash flow, high dividend yields, and does the company have room for growth in the future? Throw in some technical analysis with that, and I don't see why you would need anything else. So if this video was helpful for you for your fundamental investing, go ahead and hit the like button, and if you haven't yet, go ahead and subscribe. Join the Framework Fortune community. Come on over. The water is fine. Appreciate everybody joining me as always. Stay safe out there. Until next time.